82. 82 is 82 here in this auditorium. Or are you still outside, haven't come into the auditorium? Lucky number 82. Can I confirm? Anyone raise hand? Or the other room? Are you in the academy? I mean the academy room. My colleagues will start confirming on the other side. Right, I got no confirmation yet. Right, so if the person is not confirmed, then everyone here have another chance. Okay, so last call. So confirm, everyone see a number. Don't say that the price not good enough. I don't want. I want the grand lucky draw. So I give up this one. Then 329 already, quite good already. Noise cancelling headphone. All right, from this one from Sony itself. Okay. Okay, so last three. Confirm no 82 82 82. 82 confirm don't have last call. Okay, maybe he go home maybe like you say maybe lunch break coma already, full coma go home already. Then the price give back you. Okay, price pool one more time. Wow, this is the first second draw. Okay. Okay. Second draw. Wow. Still double digit. Wow. So now lunch, after lunch, everyone double digit. Before lunch, all triple digit. This time, both odd number. Wow, see, very good. Everyone got chance. Both odd number. This one is 75. 75 is Mr. 75 here, or Miss. Oh, gentleman over there, my colleague. He's coming over to you. Not to worry, he will record your details. All right. So thank you. Congratulations for winning the Sony noise cancellation headphone. All right. So now I'll pass the time to Xun Xiang, who will be sharing more about how to diversify your portfolio and getting ahead of the ETF investing game. All right, Xun Xiang, please.
Yes. Good afternoon, everyone, and congratulations to the gentleman who number 75 for winning the lucky draw prize. So good afternoon, everyone. Thank you for joining us after your lunch break, and hope you have had interesting insights throughout the event today. I'm Xun Xiang from Lion Global Investors. You can call me LGI's ETF guide. So I'm here today to share with all of you about two key building blocks you can use to diversify your portfolio. The first ETF I'll be sharing will be the Singapore Low Carbon ETF, which is this ETF. Key fact, it has outperformed the STI since its inception on listing date. So along the years, in the past 2 to 3 years, we have outperformed the STI. Another ETF which I will share about later will be the world's first APAC Financials ETF, which is our APAC Financials Dividend Plus ETF. It gives a quarterly distribution, annually around 5% per annum. So these are the two ETFs, take note. And before I start and give a deep dive into the ETFs, let me share a bit about LGI. We are one of Southeast Asia's leading asset managers, part of OCBC Group. And as you see here, we are further growing within the ETF business. We have around 70 billion Sing dollars of assets for our clients. And we started our ETF journey back in 2017 when we launched our first ETF, which is the Lion Philipp S-REIT ETF. Today is the largest REIT ETF on SGX already. And since then, between 2020 to 2022, we listed 3 ETFs within 18 months. And this year alone, we have already listed 2 ETFs, our Japan Active ETF and also our APAC Financials ETF. And if you apply the cutoff as of the end of 2023, 3 out of our 4 ETFs actually achieved top returns within their respective segments of REIT ETFs, China equities ETFs, and also Singapore equities ETFs, which is our Singapore Low Carbon ETF. So I mean, it's pretty amazing in terms of our growth journey. Today, we are already one of SGX top 4 ETF issuers. And our ETFs are also within the top 10 ETFs held by retail investors like all of you and myself included. If we zoom further into the segment of SRS investors, our ETFs also rank within the top 10. And By trading turnover, we also rank within the top 10. And all these are because LGI, being part of OCBC Group, we are Singapore incorporated. Singapore is our home ground, so we are committed to delivering quality investment solutions for investors, for clients within Singapore. And that's why we decided to brainstorm back then about creating a more green and also 21st century version of the STI. So the STI was built back in the 1960s, around when Singapore gained independence. I see some gray hairs here, so maybe it's some of the age, is near some of the ages which some of you were born in. So STI was constructed back in the 1960s. And because of this, it doesn't include constituents that are listed beyond Singapore. So because of this, that's why we built a greener and also 21st century version of the STI to include more constituents, not just those listed in Singapore, but also at the same time take note about lower carbon footprint for Singapore companies. Before I start and zoom into the specifics, I will start with a first prize giveaway question. So Kathleen here, my colleague, will be giving out a wireless mousepad charger for one of you who answer the question correctly. Very easy question. Who is this gentleman here? Yeah, this gentleman. The full name? Yep. So yes, PM Lawrence Wong. He mentioned in the 2022 International Energy Week that Singapore's net zero by 2050 target is actually a stretch target. But because we wanted to do our part to tackle the global issue of climate change, and this is where we started our journey in terms of decarbonization and also to achieve net zero by 2050. So all these, a lot of us, we know Singapore as a little red dot, but this also is the vision that will transform Singapore into a little green dot. And there's a reason, because climate change affects everyone. There are two types of risks that climate change poses to our portfolio. First type is physical risk, easier to understand because it has caused natural disasters, triggered loss of lives, loss of wealth. The latest example will be Typhoon Gaimi, which has affected China, Taiwan, and also Philippines. The second type is harder to understand. It's about transition risk, mainly brought about by policymakers. So for example, in Budget 2022, Singapore actually introduced an increase in carbon taxes. So for those companies that are unable or unwilling to reduce their carbon footprint, they may face higher funding costs or a potentially lower share price. So all these are important issues and risks we need to be aware when investing and building our portfolios. And that's why we built the Lion OCBC Securities Singapore Low Carbon ETF to help investors decarbonize your portfolio and at the same time include constituents, not just listed in Singapore, but also those listed in Hong Kong and also in the US. And throughout these years, especially for constituents that are listed in US, they have seen actually significant outperformance. For example, C Limited has grown just this year alone, rallied by 80%. So all these are actually constituents that help to boost the performance of the Singapore Low Carbon ETF. The key features about the ETF: it tracks the top 50 largest Singapore companies by free float market cap. There's a 7% securities weightage cap. This part is important because it provides sector diversification and also securities diversification. And third thing is about semi-annual distribution in June and December. These three key features. And here alone, we also look at the index, which tracks the top 50 largest Singapore companies by free float market cap that are representative of Singapore's real and financial economy. So this key thing will be about the reduction in the weighted average carbon intensity. Sounds complex, but it basically means it tries to minimize the amount of carbon emissions per $1 million of revenue. So we pick companies that emit the lower amount of carbon emissions per $1 million of revenue. So because of this one, you'll notice is that compared to the STI or MSCI Singapore, Our index chooses companies that emit the lowest amount of carbon per $1 million of revenue compared to the STI or also MSCI Singapore, which are significantly lower. And in terms of performance, we have outperformed MSCI Singapore and also the STI since our listing on the 28th April of 2022. This boils down to 3 key diversification this ETF offers. Because it's July, I've come up with the term GSS, geographical, sector, securities, GSS. Just remember Great Singapore Sale, geographical, sector, securities. In terms of sector, you will see a more even distribution. So you see the STI and MSCI Singapore, they're actually more weighted towards financials, around 50%. But because we apply a more even distribution and also weightage of different sectors, you'll notice that actually there's a lot more higher weightage to technology, which has actually seen a huge rally in 2023 and 2024, attributing to greater performance, while at the same time help reduce the potential volatility because it's spread out across different sectors, as you see here. In terms of geographical diversification, what you notice is that this consists of constituents listed in both Singapore, US, and also Hong Kong. So there's greater geographical diversification. As you see here, the 3 local banks are inside. There's also Singtel inside, which has also performed well during this period. But there's also C Limited and Flex Limited, and also Grab Limited. So you see here, C Limited rallied 81% as of this year within the past 6 months. Flex Limited around 37% during this period. So the inclusion of US listed constituents actually helped to boost the ETF's performance during this period. So all these brings about the diversification in terms of GSS, geographical, securities, and sector. And before I move on to the next slide, here's my next prize giveaway question. I mentioned it at least twice already. What's GSS? Yeah. So congrats for remembering GSS. So yes, these 3 are the important letters to remember because it means that you do not have to sacrifice returns when you decarbonize your portfolio. And it is possible to do good for your portfolio and the planet. And here are the ETF's top 20 constituents. You'll see here, 3 local banks are inside. There's also C Limited, Flex Limited, Grab Limited. And here will be my next prize giveaway question. I'll be deep diving into 2 key constituents of this ETF. The first one starts with S. It's the owner of Shopee, Moneybank, Garena. So I haven't asked lah. So maybe this time I take this side because okay, maybe the orange gentleman. The first, I'm talking about the first. Yes, C. So I'm glad you managed to see this. The second would be a company that starts with F. It's the world's 3rd largest electronics design manufacturer by revenue. So maybe this time I take this side. The white gentleman there with the cap. Wow, you are really flexing very well to be able to notice the white gentleman with the black cap. So yes, I'll be talking about C Limited and Flex Limited. So for C Limited, after a series of cost-cutting measures in 2023, started 2024 with excellent earnings, kicking off with a strong quarter, business growth for all 3 of its businesses, Shopee, Garena, and SeaMoney. And you will notice that Shopee actually achieved the strongest growth and record high in terms of quarterly orders, achieving a record high also in terms of gross merchandise value. So it's an interesting company. And if you notice for the next one, for SeaMoney's perspective, there's also grew revenue and adjusted EBITDA by significant amount of percentages. So all these have helped it rally around 81% since the start of the year. And because of this, if you look at the analyst target share price, there's still around 15% in terms of upside potential that has been identified. So this is a high-profile growth company. from Singapore. Next company will be Flex Limited. Similarly, started a strong quarter in Q1. And also in the latest quarter, it achieved record high in terms of operating margin. So because of this, you will notice that since the start of the year, it has grown around 37%, just by applying the cutoff at start of the year. If you apply since April 2022, this growth is actually much higher. So this is what we have noticed. And this is actually a lower profile value company. But an interesting thing about this ETF is that it is actually a high profile growth company element, but also a lower profile value company element, where you get a diversified blend of value stocks and growth stocks bundled together to help you do good for your portfolio and also the planet. So to summarize, the Lion's VC Securities Singapore Low Carbon ETF provides you diversified exposure to 50 Singapore companies committed to a lower carbon footprint. And with around $1 and remembering this SGX ticker, you get to enjoy this exposure to 50 Singapore companies that are committed to a lower carbon footprint. Right now, before I talk about my next ETF, I have a prize giveaway question. Easy question, I just dropped a huge hint. Maybe this time, what's the Sing dollar SGX ticker? Okay, this gentleman with white collar. Yes. So thank you for remembering ESG. Easy three letter, but it captures the essence of this ETF. It is an ESG fund. So right now I'll talk about our next ETF, which is the APAC Financials ETF. Okay, so this is our next ETF. Key things to remember, two key features. World's first APAC Financials ETF, 5% per annum quarterly distribution for the first 2 years. So when we think about financials, a lot of us actually think about banks. But actually financials are an ecosystem, not just about banks, but about companies that provide services and products that focus on the growth, storage, and transaction of money and assets. And it has prospered throughout the centuries because it is an essential capital provider for economies worldwide. It's an ecosystem, not just about banks, but it's also about investment management, for example, like LGI, about insurance, and also brokerages like Philips Securities and exchanges, which is, for example, like SGX, where all of us sit in right now, because it helps to smoothen the flow of capital to power economies worldwide. And when we talk about financials, actually a lot of us would just think about the global landscape, global financials, which includes the US banks. But APAC is an interesting region because it's a high growth region, a deep dive. Globally, financial services is already amongst the world's most profitable sectors. But within APAC, actually 55% of the adults are underbanked. And this represents the largest underbanked region across the world. And a lot of the APAC banks can actually simply grow further by just tapping and serving the underbanked within the developing APAC countries. And the high savings rates within APAC is also much higher than the world's average savings rates. And also within APAC, ASEAN and Singapore, which is our home ground, also contributes to the higher savings rates within APAC. Key figure, amongst the world's top 30 banks globally by assets and market cap, 14 of them, which is around half, are actually APAC banks. And this is important because APAC's high saving rate gives and deepens the deposit pool for a lot of banks and financial institutions and helps to power economies and be able to improve economic resilience across these APAC economies. And if you look at the ETF, it's APAC Financials Dividend Plus ETF. So what is in the plus? 3 key catalysts. First one is about cushion profitability. We have already seen in the past 2 years, banks globally posting record high profits and also in terms of return on equity. So much so that sector ROE is around 13%. And this is against a backdrop of around 9% average ROE in the past 14 years. And during this period, actually, is because of the high interest margins that have been contributed by rate hikes. But in this environment, we are expecting more and more likelihood of potential rate cuts. And in this kind of scenario, it's important to tap on well-capitalized banks. I'll touch on why well-capitalized banks are important because they are more likely to maintain profitability. I'll talk about it further later. And the second is about the Asian tilt key thing. The next decade, more APAC banks are expected to join the top global 100 banks because wealth contributor actually will come from APAC. So all these will catalyze the growth of APAC financials. The third is about the pivot towards capital-light models. Key figure, in the past 6 years, 16% of capital contributed to 33% of profits among APAC's financials. And because of this, even DBS in their annual report mentioned that digital customers are more profitable. And going digital, going capital light is expected to increase profitability. So this is important. And with all this happening, these catalysts are long-term catalysts. They take time to be priced in. Because of this, the valuations are still relatively attractive if you compare it with the STI or even the S-REIT leaders index. So in terms of PE, we are around 11. In terms of price to book ratio, we are still at around 1 as of 30 June. Because all these are long-term catalysts, they take time to be priced in. And some of you might ask, hey, the US rate cuts are coming. So how will this impact APAC financials? Key thing is an ecosystem with businesses that react differently to rate cuts. And second thing is that the expectations of rate cuts could actually drive more investment activity because when you reduce the risk-free rate, more investment activity will follow because you have to take more risk to generate returns. And with this, actually, some other arms, for example, like wealth management within DBS, actually posted record high profits. For example, it reached around 1 billion Sing dollars in the latest quarter in Q1. And another thing is also the banks are also sophisticated enough to protect their net interest margins through longer term fixed rate assets, for example, like giving longer term loans. And the next thing that is interesting about the ETF is that it provides geographical diversification. Because across the world, you will see that a lot of us are waiting for US rate cuts or anticipating US rate cuts. But there are certain countries that are actually looking to increase interest rates. One example is actually Japan, which has seen a lot of inflation recently with currency depreciation. And because of this, they are targeting to increase interest rates, especially in the upcoming BOJ meeting that's happening on 30 or 31 July, to increase interest rates. So what happened in the past few years in net interest margins for the Singapore banks or even the US banks could happen for the Japanese banks. So right here, you see that as Sumitomo Mitsui Financial Group, which is one of Japan's largest mega banks, said that if interest rates just increase by 0.1%, they expect to gain 40 billion in additional profits. So right now, they already hold 58 trillion with the BOJ at 0.1% interest. So it's roughly 58 billion yen in net profit. They increase 0.1% more, and they will get 40 billion yen of more net profits just by putting the money, like what you do by putting into a savings account. So by this virtue, the net interest margins, net interest income will further increase. And all these are potentially good and beneficial for the Japanese financials. So to summarize, financial sector is an ecosystem diversified across different geographies, and all these have helped it prosper throughout the centuries. And that's why we launched the APAC Financials Dividend Plus ETF to help investors like you and me take advantage of the different interest rate movements that are about to happen. So it's the world's first APAC Financials ETF, tracks the top 30 largest and most tradable APAC financials. 3 key steps involved. First is about index criteria, sector, there's banking, insurance, investment services, and also a special sector, which is called specialty finance and services, because this is where the digital banks are grouped in. And this is the part that will make the index more future-proof, because if the digital banks grow large enough in terms of market cap and also start paying dividends, they could be included into the index. Second part is about index selection and weighting. Key is about 7% securities weightage cap, and also a 20% country weightage cap to ensure geographical diversification. And in the end, what you get is 30 constituents weighted by free float market cap. And in terms of key features, remember 3 things, because this ETF helps you focus on income and growth. Focus on the top 30 largest and most tradable APAC financials. Income, 5% per annum quarterly distribution. Growth, potential capital appreciation within the APAC financial sector. And since our listing date, which is 13 May, the ETF has actually grown in terms of performance. It has outperformed the STI and also the IHS Leaders Index since its 13 May listing. And here are the different breakdowns. You will see that in terms of geographical breakdown, it's rather evenly split across 6 countries: Japan, South Korea, Hong Kong, Singapore, Australia, and Malaysia. And these are the different portfolio constituents you see. You see the 3 local banks are within top few. And right now, I will pause here because I have another 2 prize giveaway questions. The first constituent I will later talk about will be one that starts with S. I think similar thing, like the previous one, I also start with C Limited. This one also, there's also an S inside. It's one of Japan's mega banks. I'll take a question from here, the answer from here. Yes, SMFG, Sumitomo Mitsui Financial Group. Thank you for remembering. Next one starts with K, is one of Korea's largest financial groups. I'll take it from here. So me to this gentleman. Yes, KB. Yes. So it's a KB Financial Group, which is part of Kookmin Bank. And these are 2 interesting constituents because they are one of the few, besides the 3 local Singapore banks inside. You'll notice that since 13 May, because since 13 May, the listing of the ETF, the return actually has been around 15%. But you look at the Singapore banks, DBS, OCBC, UOB, they've been rather flat, around 1+%. So this is an interesting outperformer, and also Mizuho Financial Group, because these are being expected to benefit from the interest rate hikes that are about to happen within the Bank of Japan's interest rate decisions. So in terms of the first constituent, I'll talk about Sumitomo Mitsui Financial Group. Interesting company, reached record high profits. CEO already came to say that for every 0.1% increase in interest rates, they expect to gain 40 billion yen in terms of profits. Since January 2023, the share price actually grown steadily. Within May, since listing, it has grown around 15%. And it has also achieved record high in terms of net business profit and also bottom line profit. I mentioned earlier, SMFG already have 58 trillion yen within the Bank of Japan's balance sheet. And just by increasing 0.1%, this 58 billion plus the 40 billion will add up to around 100 billion yen in terms of interest income alone. So this is an interesting constituent that will stand to benefit from the upcoming BOJ rate hikes. Next company I'll talk about is KB Financial, achieved record high in gross operating profit. It also acquired Prudential Financial's Korean insurance arm back then for around $2 billion, effective January 2023. And since then, share price actually grew significantly by more than 80% within this period, and there's still around 15% in terms of upside potential identified by analysts. And it's an interesting company because in its Q1 earnings, it already announced to pay around 300 billion won in quarterly dividends. And in its latest board resolution, which just happened a few days ago, there's also announced a cumulative 720 billion won in terms of share buyback to be able to help return capital to investors. So when it's about returning capital to investors, it's not just about dividends, but also about share buybacks or cancellations to help improve the returns to investors. So these are 2 interesting constituents. And to summarize, the Lion BC Securities APAC Financials Dividend Plus ETF provides diversified exposure to 30 largest and most tradable APAC financials. Key thing to remember, 5% per annum quarterly distribution. And before I wrap up for this ETF, I have a simple question. This time I'll take answer from this side. What is the Sing dollar SGX ticker for this ETF? Yeah. Yes, YLD, because 5% sounds like a good yield, which I hope you remember after this session. And we have covered 2 ETFs today. The first one is about our Singapore low carbon ETF, key ticker to remember ESG. Top 5 constituents includes the 3 local banks, but also other constituents which are listed in the US, like C Limited, Flex Limited, that will contribute and potentially boost performance, as like what they have done in the past few years. Next ETF will be the APAC Financials Dividend Plus ETF. Same thing, if you notice, the top 5 constituents actually also has the 3 local Singapore banks inside. But there's also the Japanese financials and Korea financials that would stand to benefit from their respective interest rate movements and also the regimes that are happening. So remember, APAC Financials Dividend Plus ETF, YLD, and use it to earn stable dividends of 5% per annum in quarterly distributions. So I'll pass over the time to Huanzi, who will talk, share about the next speaker. Thank you.
Thank you. Okay, so we will have our next speaker. All right, so we'll thank Shin Xiang for sharing about the Lion Global offerings. All right, so for the next speaker, we will have, all right, Mr. Tan Teck Ling, who is the Deputy Chief Investment Officer of Phillip Capital Management. All right, so he'll share more about what whether it's time to invest in the China market. I think this is corresponding to the first one of the first speaker, Paul, who mentioned about the China market might not be in a good shape. But let's hear from Mr. Tan Teck Ling on his view of the China market. Thank you.
Okay. Hi, good afternoon. Good turnout. Hi. Yes, I think I just introduced myself. I'm the Deputy CIO of Phillip Capital Management, which is another local fund management firm. So you may be familiar with some of our products. So today I'm going to be talking, I will be starting with just a brief outlook of China currently. Before I will also talk about a way to capitalize on the China equities market if you think that you want to position into it currently, right? No prizes to give away for my end, right? But I will be conducting a lucky draw after that if there's any consolation. Okay. Right, this is how I'm going to be talking about today, right? I'll give overview of China first. And for China, I will start by talking about some of the concerns that people have, because I guess what the press publishes about China now seems to be the risks aspect of China. Namely, I think you have the property sector, everybody knows, especially the private developers in China, right? Evergrande and so on. You have the slowing economy, right? Everybody hears about that, right? Deflation. So instead of inflation, large part of the world over, we are seeing some deflation. Not so much on the consumer products, but more on the production goods segment. And thirdly, of course, everybody hears about the geopolitical tensions with the West. So these are some of the key concerns. Well, when concerns and risks are widely published, what happens? You will get weakness in the market, cheaper valuations, people recognize the risks. So does that mean that you shouldn't invest? I think there is a brand of contrarian investing where people actually look for such bargains. So it is worth considering. But before that, I will talk a bit about some of China's key segments So when you talk about economic growth, typically you talk about a few segments lah. Fixed asset investment, that means construction, building of new industrial goods and so on, right? Then you also have consumption, and then finally you have manufacturing, right? Manufacturing and services. So I will go through some of this in each of these in turn, so give you a flavor of where we are or where China is now today. So here I just start with fixed asset investment. Over the years that you see here, right? So this is 2018, 2019, 2020, 21, 22, 23, okay? So this is a time series on the horizontal scale. And the lines here shows the different components that make up total fixed asset investment that I'm talking about here. You can see that over the last 5 years, the one that indicates real estate investment, which is the brown line, year-on-year growth has actually come down a lot, right? It used to be this level positive, and then the last few years negative, right? This brown line here. So year-on-year growth is negative, as would be expected for real estate in China. But if you look at overall, which is the blue line, right? The blue line is the average of all the various sub-sector components. Actually, it has been more resilient. It is still in positive territory, right? It is still around here, which is quite close to the pre-COVID time in terms of year-on-year growth for fixed asset investment. Why? Because some of these other segments of fixed asset investments actually help to cushion the weakness in real estate growth. And in particular is infrastructure. You can see in the dark brown line here, right? That is actually still growing pretty robustly, right? So you can see that, of course, in fixed asset for infrastructure, typically is by the local governments or the central government projects, like energy infrastructure, public sector infrastructure, highways, rails, all that, right? So all that contributes to growth in the sector. So that has actually continued along. So to the extent that actually fixed asset investment is actually pretty still well cushioned despite the property sector weakness. Consumption, right? Well, here you could, I guess consumption is one of the weaker segments in the China market today. That is if you classify 5% year-on-year growth in retail sales as weak, right? That is where China's retail sales is now today. It's weak because the trend growth, say before COVID, the long-term trend was double-digit % year-on-year, right? So today, the retail sales would be something in single digit, like 5% year-on-year thereabouts, which is this top graph what is showing here, right? Below the long-term trend, right? But still positive, right? The weakness, of course, is because the confidence is relatively low among the population. A lot of their wealth, of course, is in real estate, right? So naturally, I think that also drags on the consumption sentiment, right? But certain segments are still doing well, for example, right? So if you see on the right-hand side, that is the travel volume during the Spring Festival. That's the Chinese New Year, right? You can see that actually it is higher than even pre-COVID, right? So that's something that you take note is a mixed picture for the consumption side of things, right? In fact, domestic travel is doing pretty well now, right? And for certain sectors such as household consumption goods, because of government policies, that is also doing well because the government is encouraging them to change their old domestic household goods for new household goods, right? Third key segment is manufacturing. Well, manufacturing is actually a bright spot in the current Chinese economy, right? If you look at the China exports that is shown on the export volume here, right? The latest one on this one, export volume year on year, you can see that it has been rebounding quite strongly year on year. And In fact, it is currently at a long-term trend year-on-year growth, right? So that despite what you are hearing, actually China's manufacturing sector is one of the bright spots currently, right? And it wouldn't be surprising in a sense because they actually have a critical mass of production capacity in various industries. We talk about the high end, such as electronics, but also the low end, such as textiles and household goods and so on, right? So it is not doom and gloom, right? Of course, there are the real estate sector would take some time to digest the excess inventory, right? So that is the current state of consumption and fixed asset investment as well as manufacturing. A mixed picture, right? No doubt. But to give you a picture of the overall exposure for China's trade of its goods, the exports. So you can see that actually currently, right, as of 2023, as in comparison to 2017, its exports to US is about maybe 15% of its total, right? So it's actually the exports to the various regions as shown in the blue bars. It is a pretty balanced picture. If there is some trade tariffs, as for example, Donald Trump has threatened if he comes to power. Of course, I think there will be some impact because US is one of the largest export destinations. But I think it's also possible for China to engage in various strategies. They can produce outside of China. They can look at other export destinations as they are looking already positioning to do so now, right? And this currently for the US is 15%. Of course, EU is also another one that has been talking about tariffs and so on China goods. But I guess China has more levers on the EU, right? Because China is a big importer, for example, of the EU's luxury goods, of the EU's manufacturing equipment, right? So there are some levers to push on this respect. One thing to note is the central governments and the central banks increasingly active stance on boosting growth. In the past few years, people have been talking about the slowdown, about the real estate problems, but I think the central government has been rather inactive or unmoved, right? But I think in recent months, at least 2024 so far, you can see a range of policies that they have undertaken to boost the Chinese economy, right? That ranges from monetary policy, such as cutting interest rates. That also covers fiscal policy, that means government spending, right? They actually they put forth an expansionary budget. That means the expenditure by the government will be in excess of their revenue, right? They have some property sector support. So that is a multi-hundred billion yuan support that they are putting forth to encourage the local governments to buy up the excess property sector inventory. Then I think some people will be interested in what the third plenum that was held in July, that people were hoping for some big stimulus from the Chinese government to boost the economy. Well, unfortunately, that didn't happen. At least it hasn't been announced yet. But they are talking about supply side reform to drive the development of strategic industries. So on the supply side, they are trying to, they are talking about boosting their AI sector, boosting their semiconductor sector. One big development is that they are trying to move revenues from the central government to the local governments. Local governments have been more affected by the real estate problems because they used to depend on land sales quite a fair bit for their revenue to spend, right? So that has gone away. A lot of that has gone away. So in return, the central government is looking to move some of its tax collections to the local government level to ease its problems. And the central bank has also cut the policy interest rates since, right? So I think it bears watching going forward over the next 1-2 weeks, because the third plenum, what was announced so far is just a broad direction. But the the specific measures will be announced over the next 2 or 3 weeks, right? So why China in that sense, right? Broadly speaking, I think I've talked a bit about that China is a mixed bag, but I also hinted that, of course, when everybody knows the bad news and when it's sort of priced in, to what extent, well, it is for you and me to see, but I think it's broadly well understood about China's problems. But here I will just talk to you about some things to appreciate about China, right? On a more structural level, maybe more medium to long term, you appreciate its various characteristics. Then, first of all, China is already the world's largest GDP country by purchasing power parity, right? In 2016 onwards, the red bar is China versus the US. If you adjust for purchasing power parity, it's already the largest in the world. What's purchasing power parity? That means basically you adjust the dollar amount GDP by the actual paid purchasing power that $1 of GDP can purchase in actual goods within that country, right? So that's basically the actual purchasing power of that $1 of GDP, what that means. So that's what people talking about when they say PPP adjusted. So China has been trying to move to a more domestic consumption-driven economy, right, over the past few years, what they call a dual circulation economy, right? So this gives some confidence that the transition should be, at least they have a critical mass in order to effect this transition, okay? Stock market-wise, China is already, I guess you would say, the world's second largest stock market by the value of the companies listed inside the stock exchange, right? What is shown here is Shenzhen and Shanghai and Shenzhen Stock Exchange. They are respectively the world's 4th and 7th largest stock exchanges. And that's excluding Hong Kong, right? Hong Kong, if you exclude that, if you include that, even bigger. By stock market total value as a function of GDP, the US is stock market value versus GDP is 200%. In comparison, China's corresponding number is between 70 to 90%, right? I think Warren Buffett has some indicator, right? He used to compare the stock market value versus the GDP. Anything above, say, 100% or above around there, he considers that he may not want to buy stocks during that period, right? So that's here we are sort of using the indicator to measure these two countries. So research and development. So the key thing to note here is mainly that whether you look at R&D spending on an absolute value, so here it's showing by billions dollars. Whether you're talking about R&D spending, where you compare China and the US, or you're talking about R&D, the results of R&D, that means the papers that they come out with, the share of global high impact papers. China is actually one of the world's largest. It's comparable to the US, right? In terms of both input and output on the R&D end. Now I talk about the capital markets, that why China shares, right? So this, a good reason is that China A shares. So China A shares, I will explain more in detail later. What you know typically may trade in, for example, Alibaba, Tencent, and all those in Hong Kong, right? Those are typically known as the China offshore shares. China A shares is the China onshore shares, right? Those that are traded in the China domestic market, those are known as the China A shares. Well, for China A shares, the correlation of these A shares versus the various major stock market indexes, such as the S&P, such as FTSE 100, or so on, or the Nikkei, the correlation is relatively low, right? Anything below 30% is low correlation. Anything above 70 to 80% is very high correlation. What is correlation? Correlation means when one market goes up, the other market, how is it expected to behave? If it's high correlation, means both markets expected to move in unison, which is not good for a portfolio, because when you have a portfolio, what you're trying to do is to have a diversified portfolio so that they sort of cancel each other's out, and then your portfolio's volatility is more is mitigated, right? So that's one of the positives about China A shares, low correlation with major markets elsewhere. Second thing is, of course, that China's equities, if you look at the dark red line here, as measured by the A50 index, which is basically the 50 leading A shares on the China's stock market. Well, it compares, it is, as you can see, it's low PE ratio versus markets such as S&P, or you're talking about the Nikkei, over 20 times PE. So China's A shares is about below 10 times. And that's comparing across regions, but also on a historical level, right, is also quite low compared to, say, of just 2 years back, right? This is just the government's, just to give you an appreciation for the China market. The China government, it has the world's largest forex reserves, and it is also quite low in terms of the government gross debt versus the GDP as a percentage compared to other economies. So the key thing here is to tell you that if they wanted to stimulate the market through some mega stimulus package, they could, but they are choosing perhaps not to. Perhaps they are looking at it over a extended period, perhaps to prepare for a new US president. Maybe they have some additional packages up their sleeves, right? China A shares, I just want to highlight the pie chart here. If you look at all the China shares that are listed globally, including the domestic as well as the offshore shares, the domestic A shares actually comprise more than 3/4 of the total by market value. So if you wanted to look at China, what I'm saying here is that you should and you could now look at invest into this sector because this is actually where the broad value of the total value of the China's industries and companies where they are listed in on the domestic market. Right, and just to give you a brief flavor of some of the companies, major stocks that are listed on the A shares. H shares, everybody is familiar, like Tencent, Alibaba, ADRs in the US. I guess some of you might also be familiar, right? The key thing, I guess, is also that the beneficiaries of China's economic transformation, a lot of them can be found in the China's A shares market, right? This one I'll cover more in detail when I'm talking about this. So I will save that for later. So here I'm going to be talking now about our Philip China Universal MSCI China A50 Connect ETF. If you look at this product, actually it's a collaboration with China Universal, which is a leading mainland China fund company, right? And it is basically benchmarking this MSCI, is the index provider, China A50 ETF. So basically, A50 is the leading 50 stocks on the China A shares market, the domestic onshore market. Okay, so that's how you can interpret the name. Okay, the structure. This is how the structure is like. Basically, this is what is listed in Singapore. So what we do, we don't actually buy the underlying 50 shares. What we do is actually we just buy an existing ETF that is run by China Universal on the Shanghai Stock Exchange, right? This is now facilitated because there is a SGX ETF link that was established and formalized by MAS and SGX. So that is the link that we are running on now for this ETF. We don't have to buy all the 50 stocks. We just buy an ETF that tracks those 50 stocks. So in that way, both the master and the feeder ETF in Singapore are able to track the benchmark index, which is the A50 index. The key thing, I guess, to highlight is that in the past, it used to be difficult for people to buy into China A shares. Of course, then there was the Stock Connect in Hong Kong, where you can do that now, right? You can buy into China A shares, through Hong Kong Stock Connect. However, here we are listing a product in Singapore in Sing dollars, where you don't have to necessarily go to Hong Kong in order to buy China A shares, because now it is convenient and efficient. You can just buy into this ETF in Singapore using your natural Sing dollars in order to access the 50 leading stocks in the China A shares market. So that's the key value proposition for this ETF. Just to give you an idea of how this MSCI China A50 index is compiled, okay? So the parent is, the starting universe is the China A market, China A shares market, thousands of stocks as a start, okay? Now, typically for a normal market cap weighted index, you would basically weight the stocks based on, you typically select and weight the stocks in the index based on their free float adjusted market capitalization, right? So typically you would do that, right? So that is also done here for part of the stocks. But the way for this index, in order to ensure that there is adequate cross-sector representation, what it does is before this is done, the index provider actually makes sure there is 2 sector leaders from each of the 11 GIGS sectors, right? The 11 major sectors. For example, the GIGS sectors could be industrials, basic materials, financials, technology, right? In utilities, telcos, and so on. Okay, so two of the biggest companies in each of the 11 sectors, they are first and should to be inside this index first. So 2 times 11, basically there will be 22. Then, in order to make up the 50, then the remaining 28 is selected just based on the largest market value, right? So basically that's how this MSCI A50 is compiled in order to arrive at the final constituents. So basically that is how it's done. And ultimately what you get for this ETF is therefore, first of all, there are the core assets. That means the biggest companies in each of the 11 sectors typically. Second thing is, of course, sector exposure is well balanced, right? Because of the deliberate index methodology to ensure sector representation. So for example, you can see that as of the last update, none of the sectors has more than 20% of the whole index or the whole ETF, okay? And the top 10 stocks actually comprises near 50% of the total, okay? These are the top constituents, and just to give you a flavor for what is their sector, as well as well, each of them are basically leaders in their respective industries, right? Some of them may be familiar to you, such as Guizhou Maotai, right? The spirits leader. BYD, leader in cars, electric cars. CATL, leader in electric vehicle batteries. Some of you some are not so familiar, but that's exactly the reason why you want to buy an ETF, right? Because what you don't know may actually do better than what you know, right? And for a large market like China, right? Some of these sector leaders, like Zijing, Wanhua, Luxshare, they're actually leaders in their respective fields. So this, for example, Zijing is a top 5 leader in a global basic material mining, such as copper, okay? Luxshare is a big manufacturer of components for Apple in China. Foxconn will benefit from because what they do is robotics and so-called industrial internet, the cloud of things in manufacturing, which is exactly what China's government is trying to promote now, smart manufacturing. So basically, but through this ETF, you'll be able to access this very conveniently. You may not want to do that much research into individual stocks for China. You just want exposure to China at a valuation or a point where you think is reasonable. And definitely, I think if you look at valuation, I guess China is definitely a better point than say 3 years ago, 2 years ago. Okay. Now, finally, I just want to give you a flavor of this is the rate performance over of the various China-related indexes, right? Various indexes that track China's shares over the last 10 years, 2014 to 2024, the performance. So the index I'm talking about, which is the red line, MSCI China A50, is the red line. So that has delivered something like 80%. The few around here are all tracking China A shares, the domestic shares, but I just want to also draw attention to the gray ones that have underperformed over these 10 years. Basically, they have the gray line, if you look at these two, right? Basically, they have gone from 1 back to 1. Basically, effectively, what it means is delivered near negligible returns over 10 years. And this is the China all shares. It's not China A. Yeah? This dark gray line is China all shares. The light gray one is MSCI China. What do they track? Basically, what they are trying to track is the entire universe of China shares listed across domestic China, listed in offshore China, listed in the US, listed in Hong Kong. Well, guess what? Basically, the offshore shares have not delivered long-term return at all. But if you invested into China A shares, just the domestic part alone, at least you get reasonable returns over 10 years, 80%. So I'll just end this slide. If you wanted to find this ETF, it's listed on the SGX. The ticker, you can just find FCN, 3-letter ticker, then you can find it. Underlying is 50 A shares on the 50 leading A shares on the domestic China exchange. So with that, I think I will end off and move on to the next part that everybody might be waiting for.
Right, thank you, Mr. Tan Teck Ling. Please stay on stage. We will have the next segment, all right, which is actually the lucky draw. All right. So for the lucky draw, all right, this is the fourth and the last lucky draw before the grand lucky draw later. Right. So we will have the Kahoot quiz before the grand lucky draw. So like I mentioned, do keep your bingo card with you at all times. All right. So now we invite Mr. Tan Teck Ling to draw one number. Can you just shuffle around and draw one? All right. All the best for the fourth lucky draw prize. The fourth prize will be actually also a Polaroid, but this time it's a photo printer, right? So it's worth 169. All right. So this is basically the Polaroid High Print Gen 2, 2x3. Okay, so it's a bit long, the name, but then basically it's just a Polaroid printer for photo. Okay. Okay, back to similar to the AM session. All right. So now we have a 3-digit winner. First digit is 1. Right. So 100 plus. So if you are above 150, you can listen up. You might be the winner. The ticket number now for the fourth prize is 176. Is 176 here? Oh, in front, right in front. I think I need my colleague. Yes, he will be coming down to hand over. All right. So congratulations for winning the lucky draw number 4. All right. Okay, so do take note. The first to 4 winners, later I will prompt you when to come down to collect the prize also. All right, so the next segment that we will have, all right, will be the panel discussion. All right, so together we have we have a moderator along with 4 other speakers. All right, so Mr. Kang Wei Chin, all right, Associate Director of Securities Trading Equities for SGX Group, who will be the moderator. Then we have Raphael Goh, who is the Vice President of Intermediary Distribution for CSOP. Mr. Lim Eugene and Mr. Ong Jun Xiang and Mr. Tan Teck Ling. These are the 3 speakers previously as well from the respective ETF issuer. Right, so welcome on stage for the panel discussion. Give a warm welcome to them. Thank you. So as they take their seats, the panel discussion, their discussion will be regarding the future of ETF, emerging trends and hidden opportunities, and the power of DCA. One more thing to note is, I think on the 2 screens on the left and right, you will see that there is a QR code for the pigeonhole for you to scan right now. and to ask questions. Right. So this is somewhat like a Q&A. Of course, they might not be able to cater to all questions, but do feel free to add in. For the online participants, you can also scan the QR code to add your questions in. All right. Then you can actually ask questions that you might have along the way that you actually want to ask them just now, didn't manage to ask along their this presentation zone. So now I'll hand the time over to Wei Jun, who will moderate the session. Thank you.
Thank you. Yeah, and very good afternoon to everyone. This is Wei Jun. I'm in charge of the ETF business at SGX. So we are pleased to have all you here today, and it's great to see you staying through the entire day. We are getting quite close to the final draw, so do hang on. So this panel discussion, we will try to sum up all the sharings and I think what you have learned earlier throughout the various presentations. We hope that this panel discussion can hear the views of certain questions directly from our key speakers today and panelists. During the session, you're also welcome to submit any other questions you have. We have prepared a few questions, but if you do have any questions you want to ask, and you want to help others to understand better, do scan the QR code on the both sides of the auditorium. This will provide you with a web page whereby you could enter your questions. So without further ado, I think by now you will have heard from most of our speakers here. Rafael, he didn't present earlier on, but he's also our key panelist today from CSOP. And we've been working with him closely in also educating the local investors on ETF investing. So without further ado, I'll start off with the first questions. In fact, if you were here earlier in the morning, I think our market strategist, Jeff Howey, has given everyone a very good, I think, history and also the current trend of the ETF market. So we have our first ETF more than 2000 around year 2000, more than about 20 years ago. And since then, we have seen an expansion of ETFs into key asset classes, gold, fixed income, REITs, this example. So I would like to add probably the first question I have for the panelists, your views on why over the recent years it has gotten so popular. And I think most people in this room will have known what is an ETF by now. And maybe also on a more personal note, which was the first one you got in touch with, and also how has things changed since the first time you invested into an ETF? Maybe I could start off with Rafael.
Yeah, hi everyone. Thanks for staying through, and thank you, Philip Securities, for inviting us on this event. Okay, so basically, I think the rise of ETF that we are seeing right now is ever since probably you will see the trend starting 2017, I believe. During that period of time, it was when I just started out my career in sales and trading as well. So during that period, we saw quite a few fintech companies coming into Singapore, and not just Singapore, but within the region and over in US as well. There was also a rise of all these robo-advisors that we're seeing in the markets today. And for ETF-wise, being robo-advisors, the rise of internet broking platforms, cost has always been an issue for them. And always they think to drive costs lower, and which is why I think during that period of time, they were selecting some of these investment solutions for their target audience. And when cost coming involved, in their mind, ETF would be perhaps the right vehicle for investment, or for those who are not financially literate. That would be the most simple way for them to access the markets without too much of scrutinization of the underlying itself. And next up, in terms of the first ETF that I exposed and I actually own, because I was in the sales and trading platform previously, I was doing sales and trading. Actually, I come across various of ETFs since my clients trading leverage and inverse ETFs, getting themselves invested. Some of the CIOs themselves, they are invested into broad-based index ETFs, which are likes of MSCI, SGX, Japan, STI ETF as such. So from that perspective alone, I did follow, because one of my clients was one of the CIO of this family office based in Singapore. I had a short conversation with him. He shared with me is that you don't have much time to look into the underlying. Just look at the index, broad base. If you like it, you should just stay invested and keep a diversified approach. And that's where I started off with STI ETF and then MSCI SGX Japan. Like that.
Thanks, Rafael. I'm followed by Teck Ling. Would like to share thoughts. So Teck Ling is the Deputy CIO of Phillip Capital Management.
Yep. Yeah, I guess the trend typically, as with a lot of financial products, starts in the Western world, right? US. And today, I guess in the US, it was reported just a few years back, the share of assets in ETFs has already exceeded the share of assets in mutual funds, which is what we know as unit trusts. So ETF is a phenomenon over there. And increasingly in Asia, I think that has also taken root. I guess, people over the years through new structures and companies such as robo-advisors, right? So this has also helped to popularize the concept of building a portfolio with ETFs. You don't just look at stocks alone, right? Or you don't look at mutual funds or unit trusts alone. ETFs can be an effective building block to effectively get exposure to a given market. It's convenient, so that's one that is a reason for its popularity. Second reason, I guess, is it's transparent. It is you know exactly what you are buying into, right? Not so much a unit trust, I guess, because sometimes you don't have exact insights into what the fund manager is doing. So I guess for those who want to take the investments into their own hands, an ETF is a transparent way to do it. And I guess the thing is also that because you can actually trade it on exchange just like a stock, right? It's very easy. You can get in and out at whatever price you want within the intraday period because that is quoted just like normal stocks. Second part of the question, I guess, I think I bought my first ETF, which was a gold ETF, right? That was around just after around 2009, 2010. So I thought maybe it was a good time because the amount of money printing that was going on, eventually that would translate to, inflation and benefit commodities such as gold. It wasn't a good experience because I think I was not patient enough, right? So in the end, I just exited with marginal gains, maybe even a loss, I can't remember. But I think, if I had waited longer, it would have been a different story.
Yeah, thanks, Teck Ling. In fact, Gold ETF is also used actively by our institution and retail investors. Simple reasons, because I think for those of you who have bought physical gold, probably it's not as convenient as buying a stock, right? You need to look for a particular trusted parties or banks or bullion house to purchase it, and they may come with pretty high transaction cost. But in Gold ETF has garnered quite a bit of popularity since its debut, due to the convenience of trading and buying it like a stock. Maybe for Shun Xiang, Eugene, your story on the first ETF you own.
Okay, so in terms of ETFs, I feel they have three key benefits, which my fellow co-panelists already mentioned. First is about low cost. Second is about liquidity, because it can be easily traded in and out on an exchange like SGX. And third is a feature that's been ignored so far. Actually, it's something a lot of institutions value. And this is called diversification. So three things: low cost, liquidity, and diversification. And in fact, one of the first few ETFs I've owned around more than 10 years ago was actually the STI ETF. Because I'm based in Singapore, Singaporean, then if you think, wow, since when you are young, then you heard about STI. And I equate and feel ETFs are a bit like Lego building blocks. You use it to mix and match to build your own portfolio. But since then, my portfolio has also evolved further, evolved beyond STI ETF already to include, for example, a greener version or more modern version of the STI, for example, like the Singapore Low Carbon ETF. Also diversified beyond the three local banks to include APAC Financials through APAC Financials ETF. So to Eugene.
Yeah, I think everyone, the fact that we have 4 different ETF business development directors, CIOs sitting here talking to everyone is testament to the fact that it only took 30 years as an industry for ETFs to overtake in a way the unit trusts. And I know it sounds a bit cheesy, but I thank the audience, right, for looking at ETFs as an avenue to really give you the best sort of like bang for your buck in terms of investments, diversification, low cost, and also the fact that we have all been hitting the ground over the last, I don't know, 7 years combined, I think we've got, I don't know, 50 years if we are very old of experience, right? Or more. Talking about ETFs, right? So it's both the fact that the ecosystem in Singapore has grown so much over the last 10 years, right? If our partners here, if Phillip Securities, partners like Phillip Securities, if SGX and ourselves, we were not doing it together, we wouldn't be talking about why ETFs are so important in your investing lives at any one point of time. That's the first point I want to make. Second point is that my first exposure to the ETFs were actually the Lion Phillip REITs ETF, because simply put, I was in SGX at the time. There was a gong ceremony, and I watched them hit the gong, and right, and it's simple as that. And why did I continue investing in ETFs? Why not single stocks other than diversifications? Sometimes it goes down to a very simple reason. In my case, it was compliance approval. Who works for a financial institution here? Okay, other than the Lion Global people, right? Other than our friends and partners. But sometimes it's as simple as that. A simple product feature. We're not even talking about investment thesis, exposure, portfolio construction, right? It's just, should I buy a single stock and all the hassles that it has to go through, or can I just buy an ETF at one shot? So I think those are the 2 points I want to make. Thank you to everyone here. Thank you to you guys in the audience as well. Thank you to SGX. We've come a long way. And I think we still have quite a bit more to go, and we're very excited about it. Yeah.
Thanks, Eugene. Yes, Lion Phillip S-REIT was launched before I joined, but I did hear a story that it was a very successful IPO. People are queuing till midnight to get subscription. And we are thankful to have such innovations. Nonetheless, we do know that the REIT sector hasn't done well in terms of returns lately because of rates environment. But we did see that in the first half of this year, actually, REITs and fixed income ETFs, these are the newer innovations compared to equities, has garnered a lot more interest. Retail investors trading REIT ETFs jumped by 50%, fixed income 30%. And I think today we have both speakers from Nico AM, Eugene, and also Lion Global Investors, Xin Xiang, that have done a bit of sharing in terms of the products that they have. Of course, Bruce, who was from CSOP, also shared about the REIT sector. So these are very closely related to REITs, which is very close to our hearts, and also fixed income. So may I first direct these 2 questions to Eugene and followed by Rafael. Right? What do you think has driven the interest in REIT ETFs lately? Fixed income ETF as well. So since they were launched in probably, I think, less than 10 years ago, how have you seen the adoption evolve? And what should investors take note of when they are buying into such products like a REIT ETF or bond ETFs?
Okay, maybe I'll start with bond ETFs, because I think that's what I spoke about. If you managed to attend my session just now, and Bruce and Rafael they'll talk about REITs. So fixed income, I like to say that in 2022, did T-bills, who has invested in Singapore Treasury bills? In the last, who invested more than 5 years ago in T-bills? Okay, so 2 years ago, T-bills, raise your hand. Okay, about 20, 30, more than 5 years ago, T-bills. I just see one hand there, right? So I'm a bond ETF business development director. They always ask why bond ETFs versus T-bills, and I came after 2 years of hitting the ground. I think of T-bills as the Chris Hemsworth, if you know the Hemsworth brothers, Australian actors. He's the more popular one. He's the good-looking one that everyone is talking about, T-bills. Then bond ETFs were from the same family. The underlying is the same. That's not as popular. A bit more difficult to understand. No one really knows who Luke Hemsworth is or Liam Hemsworth, right? But yet the underlying is still the same family. But because there's so much interest in T-bills, I think that's really the question that Wei Chin is asking. How has that translated to bond ETFs? Really, because I think it's a complement as a structure, you're still investing in roughly the same family. The risks and rewards are roughly the same. But then because bond ETFs, there are some complexities, but there are also some benefits involved. We have benefited from that rise in your knowledge and understanding of what a fixed income investment was. My job would have been so much more difficult if I was the BD guy 5 years ago, because of audience here of 250 people, only one person kind of may have more advanced understanding of fixed income. But today it's easy. And I think that's really driving interest in bonds. And that's the good part, right? But the bad part is that why has T-bills, why has fixed income as an asset class become such a big problem? Because on the ground, we are facing inflation. And that's what central banks have been trying to tackle and dampen down over the last 2 years. So I think it's a mixed bag. It's because of a problem which has led rise to a lot of interest in an asset class that was not very popular. But in a way, that's also good in terms of understanding, investor understanding of a slightly more difficult to understand asset class, right? And this is a journey that we'll probably have to continue, because what's going to happen next is what next, right? If the inflation cycle starts to turn, I think the next question is, if it's peaked, is it going to come down? And if it's going to come down, is it going to come down back to, the generation of low, zero, or even negative interest rates, right? So that's something that we have to tackle. But I'm confident that the ETF industry as a whole, as product issuers, new advancements, we'll have more products to meet that needs as your investment needs evolve.
I mean, for Rafael, since we know that REITs, many of the local REITs are diversified in their own, right? And a lot of REITs are diversified REITs. So why do we still see investors going to REIT ETFs, which adds another layer of diversification on the already diversified portfolio?
Okay, so before I answer this question, can I show of hands how many of you have are holding on to individual REITs counter currently? You see, most of them. Okay, so the other question I'm going to give it to you is that how many of you, when it REITs issues, rights issue, how many of you got burnt or you have to find headache dealing with such issues? Like, for instance, having to subscribe to the rights issue, lowering your cost of the current outlying share prices. These are all headaches for the current investors at this current juncture. And as we speaking, holding on to individual REITs themselves, they have diversified underlying properties. You're not wrong. But some of them are specific in terms of their sectorial exposure, which is why we always emphasize when you are invested in REITs itself, it is always good to be diversified in terms of not just the properties exposure, but also looking at the sectorial exposure, the country allocation as well. These are a few sectors that I think when money flows, you'll be still capturing all these flows within the money market movement. And with a REIT ETF, this will allow you to be able to keep track of that.
Yeah, thanks, Rafael. Maybe I'll move on to the next questions. For those of you who might not be watching the market closely, we have seen STI hitting a multi-year high, historical high lately in the first half 2024. And of course, besides the two STI ETFs that we have on SGX, we do have other Singapore-based ETF as well. For example, a few years ago with Teck Ling, we have launched the first Singapore Sing Income ETF. That focus on the high dividend paying Singapore listed companies. I'm not sure how many of you here have subscribed to it, but since then, I think you have decent traction among investors looking for income. And lately, just 1 or 2 years ago with Lion, we launched, probably have shared earlier on, Singapore Low Carbon, which then offer a bit of a climate tilt toward the Singapore companies. So maybe my question for this will be directing towards Shin Xiang, followed by maybe Teck Ling as well, and Eugene, because we do have Nicole STI ETFs. What do you think such thematic ETF, or how have they performed since their debut? And also, what role does a broad-based Singapore vis-a-vis income Singapore, low carbon Singapore should play in investor portfolio? Because obviously I only have so much money, right? And how much should I put in each of these themes? Maybe some sharing starting from Shin Xiang.
Thank you, Wei Chin, for highlighting our Singapore low carbon ETF. So it's great to hear that the STI has been hitting new record highs, like what Wei Chin shared. An interesting thing is it has been actually hitting record highs because of the 3 local banks that have been doing well. So because of this, we have seen improving net interest margins among all these banks. On the flip side, it is also good and important to consider diversification in 3 different aspects. GSS, easy to remember, Great Singapore Sale. G for geographical, because if you include constituents that are listed beyond Singapore, for example, like US or Hong Kong, you may get a more different performance outlook. Sector, because if you have include and greater allocation to the tech sectors that have already seen a rally, it could be beneficial for a portfolio. And also securities, because the STI in fact was constructed back in the 1960s when Singapore actually just went independent. So because of this, that's why we were thinking back then, maybe we could construct a more modern version, 21st century version, and also a greener version, because decarbonization was the upcoming trend of the STI, to offer investors another low cost and affordable avenue to assess Singapore's domiciled companies, not just listed within Singapore, but also listed beyond Singapore, for example, like US and Hong Kong. And since its inception, we have also, we're glad to share that the ETF actually has outperformed the STI in the past few years since inception on 28 April and 2022. So I think it's a good way that and also to signal that you do not actually really have to sacrifice returns when you decarbonize your portfolio within the climate change action.
Maybe I move on to Teck Ling on more on the Sing income and how does dividend plays out?
Yeah, so we have this Philip Sing Income ETF that buys into Singapore stocks as well. We launched it in 2018, late 2018. So now he has over 5 years of track record. The way that we constructed the index is it wasn't licensed off an existing index, so we actually worked on this, designing this index with Morningstar for this Philip Sing Income. And what it does is it tries to pick out quality, high dividend, blue chip companies. So starting universe is still based on the biggest companies in the Singapore exchange. But we try to apply certain filters on it to make sure that what comes out, the constituents of the index would be so-called quality companies with solid cash flow, dependable cash flows. Doesn't like fluctuate too much. They have a strong balance sheets, so they won't they don't have financial problems in adverse economic times. So basically, it's along our theme of what we are trying to develop in our REIT ETFs previously. One of them is with Lion, the S3 ETF. We did this one also along the theme of trying to develop income-focused kind of ETF, right? So this one is our take on an income-focused ETF focusing on the Singapore market.
And one interesting fact on the ETF, Teck Ling just told me a few weeks ago, it has Great Eastern in one of the constituent, which probably makes it quite a different ETF compared to the STI. And maybe lastly to Eugene, maybe you have the last word here on STI. So what role does it play with among these thematics and dividend play?
No, so two things. I think a rising tide lifts all boats. And well, we were the first. I think it's just because historically we were the first. Second, sorry. So there was the State Street STI. For some reason, we thought we would also want, well, Nico M used to be DBS, and I guess DBS needed to have an STI ETF. I think that's the reasoning, right? Corporate, right? It's just a Singapore story. But we're not apologetic that we had the first or second STI. But a rising tide lifts all boats. Just because you have got let's say a restaurant. I've got a friend who's a restaurant owner, and he says that in my dessert menu, I must always have one of the basic desserts, like a simple chocolate cake or a vanilla ice cream. Because 70% of the time, people who are uninitiated, who do not really know what they want, but want to just have a piece of dessert, they'll go for the plain vanilla option, right? And just because we happen to be at the choice earlier, right? No fault on anyone, no fault on us as well. It's just the case. But then, as I said, as markets evolve, I'm actually very happy that there's actually more interest in ESG, low carbon, climate changes. Why am I a lot more happy now? Because on a personal level, when you've got kids and you think about rising sea levels and where Singapore's place literally, in a world with rising sea levels is, do we need to be more conscious about where we put our investment and our dollars, right? So I'm very happy that there actually is more interest in products that give you certain aspects that should be important to you. It's important to me, it's important to everyone here on the panel, right? If dividends is important to you, then I'm also very glad that other than the plain vanilla option, if you want something else, that's also good for you. And once again, it goes back to the very first point I mentioned, more interest in all of our products is good for us as a whole. That's why in another 30 years time, right? Maybe the question now would be, no one has been able to displace the ETF market, right? Where do you see yourself from there? But that's a good problem to have.
Yep. One final point to make. So you can imagine STI is like the chocolate cake, but Singapore low carbon ETF is like matcha chocolate cake.
Yeah.
Green version. So for easier memory, easier reference.
Yeah.
Matcha chocolate cake. They coexist, both are tasty.
Yeah.
Go ahead,
Just
Raphael.
want to add a little bit more. Okay, so for low carbon wise, I think most investors here, can I have a show of hands? Does the negative connotation of low carbon comes into mind? Because right now I can share with you, over an SGX, one of the best few performing ETFs are actually with low carbon in their name in it. And also over an SGX beyond Singapore, and we have one of the, I would say, Singapore's biggest secret is a CSOP APEC low carbon ETF. In fact, it's also one of the best performing ETF on over listed on SGX. I think year to date it's up over 40%. And basically because of the underlyings itself are Asia Pacific corporates with the likes of your Toyota, your Samsung, TSMC, and as such. And interestingly, I think the low carbon is just, I would say, ESG themed named over it. But I think the real name is for such product should be, it is considered as a quality select product, because such of these companies, they are screened through a more stringent process compared to the rest. And you can only imagine that only companies that pass through these stringent processes, they are definitely or generally or most often than not the cream of the crops.
Thanks, Raphael. Yeah, indeed, I record that ETF to have like a 40% exposure to Japan. So for those of you who are looking for Japan exposure, actually that one does has some coverage. And the best kept secret is that all these are available under Philip Share Builders Plan. So if you do want to get started in a DCA manner, that's a good way to get started on those ETFs. Maybe moving beyond Singapore, and I was here for Paul's head of research, Philip Securities sharing earlier on. I think if I'm not wrong, the outlook to China isn't that great according to his sharing. So probably now we do have a few issuers here. In fact, all of them here have some ETFs that are related to China. So they must know something that probably I wouldn't know. So I'm going to start with probably Teck Ling, right? What investors should take note of? Maybe before that, I asked this last week as well. I'd like to know who are holding stocks that are related to China now. Hong Kong, ETFs, China A shares. A show of hands, be honest. Okay, probably close to 20%. The other time we had 80%. But that was the how to navigate through China seminar. So with Teck Ling, maybe you can start off. What should investors take note of? For two type investors, those who are already invested in China and those who have not yet invested into China.
Well, I just presented before this panel about China. So those points are already made. It is a rather mixed bag the risks are well published and possibly well valued in, I think the fact that a lot of institutional investors are light on China may be a good thing. That means that if they wanted to buy back into China, there would be resultant inflows. So always, I guess, look on a flip side in a manner that is possibly, I guess, apart from the public thinking. I think that it would be how I would suggest the investor to think. You may want to, for those who are already in, then I think it may probably just make sense to hold on, because like I said, you are already in the situation is such that the equities, the exposure you're in for China is it may have already dropped somewhat, quite a fair bit, right? And the valuation is probably quite reasonable now in a sense, right? Whether it's stocks or you're talking about ETF or whichever, right? And for those who are not in, or maybe generally as a whole, you could if you wanted to get exposure to China, right? Let's say you are generally positive on China. Well, there are a few ways to do it. So here I'm talking about the approach to it, rather than should you go for China or not China. But here I'm looking more at the drilling down to the second level. What is the ways that you can do it? I guess it is possible to diversify over time and space. What do I mean by that? So basically, time. You may not want to time the market. You could ease in over a period. So, ways such as, I guess, was mentioned, share builders plan. You just have a regular portion of your income going into the various investment instruments that you want to funnel it in over a period of time. So you don't want to time the market at one particular lumpy point, right? Unless you are particularly convicted. That's what I mean by over time. Over space, meaning over a basket of stocks. Don't try to pick. So there is one approach that people generally advocate, which is to use ETF as a building block for your intended allocation. So what is called a core satellite portfolio. If you wanted to have, say, a key part of your portfolio as China allocation, right? The rest could be US and so on. But let's say China, you designate it to be part of your portfolio. Then an ETF that is reasonably well diversified, say, an ETF of leading China stocks like what I just presented, that could be a core part of your China allocation. And then you want to select individual stocks that you are particularly convicted on, that you believe strongly in, that forms your so-called satellite. So, a core ETF surrounded by satellite individual stocks. That could be how you approach your China allocation if you wanted to allocate.
Thanks a lot, Teck Ling. And maybe I give some time to Rafael as well, because CSOP pretty have an extensive global suite of China-related ETF. In Singapore, recent years have been launched dividend focus, and so one that is tech, semiconductor focused ETFs. So maybe for Rafael, what's your view on such thematic play in today's environment?
So I think for China, it boils down to one thing, the government policies and the government initiative. So for those who want to get exposure in China, I think the keynote here is to always focus on the government's initiative. If the government is going to expand their semicon manufacturing capabilities, and be sure that they will be putting in a lot of effort on it. And perhaps that may be one area for you to look at, perhaps certain ETFs that focuses on their technology. The other spectrum to look at is also, if you understand the Chinese government and how the businesses there work, mostly if let's say you want to get a safe dividend payout, you can consider certain ETFs that focus like our SHD, the Shanghai Dividend ETF, which focus a lot on the state-owned enterprises. And these companies generally are state-owned entities, and they will pay regular stream of dividends on the end.
Yeah, thanks a lot, Rafael. So we have some time now we will be moving on to the questions. We have like a lot of questions submitted, about 30 over of them, or nearly 50. So maybe let's move on to some of them that we have top votes. The top one is interesting. With ETF around, will they progressively replace unit trust? It's a far lower cost option, and do we still need unit trust? Maybe I give this question to Teck Ling, because Phillip Capital Management, as we know, they do have a wide range of unit trusts as well. So what's your view on this?
Well, yeah, so that's correct. One of the positive points of ETFs is that they are lower cost, right? Low management fee. Do we need unit trust? So I think there's always a space for both kind of products, right? ETFs, you are trying to track a certain benchmark, right? Unit trust is trying to do better than the market. It's just like saying, is there no space to do stock picking, right? It is not really true, right? If it's a situation where you want to do better than the market, right? You have looked at this fund manager, and they have a good track record of, they have a certain edge in their field of expertise or their investment mandate for that particular unit trust. And of course, that is the reason why a certain unit trust has a long track record, because they have a track record of delivering alpha, which is basically the return in excess of the benchmark that they are trying to track, right? So, I actually tend to think that, for example, if you have ETFs and then ETFs become the predominant instrument across the whole market, there should be even more space for stock pickers, right? Because the ETFs would be tending to track a particular field of stocks, and therefore the ones that are missed out, not within the universe for whatever reason inside these ETFs, they will be unfairly cheap, right? And that's probably where active stock picking can come in, whether in the sense of a unit trust or whether in the sense of just buying the stocks yourselves, right? I think there's always room for these few kinds of approaches.
Yeah, thanks, Tim. Anyone to add on?
Okay, I can add on. So similar to chocolate and matcha chocolate, ETFs and unit trusts are also similarly able to coexist. Because for unit trust, sometimes because I also do both product and sales. So from product perspective, from unit trust, you need to open all the market accounts. For ETFs, you open market accounts, but sometimes for some specific strategies, right? The underlying market, actually, they can be more illiquid. So it can be actually, from ETF perspective, the key advantage, one of the key features is actually liquidity. But it might be hard to actually, for market makers to market make and provide liquidity. So because of this, for some specific strategies, it could be better to launch in a unit trust form, because you don't need to provide so much liquidity on the exchange to make it readily priced. So this actually makes it sometimes more favorable than an ETF form. But on stuff which actually have more liquid constituents, maybe ETFs could be better, because they allow liquidity for retail investors, like including myself, to be able to access in and out. So actually both can exist, like chocolate, matcha chocolate. It depends on actually more on your preference, which one you feel like eating that day. And then after that, you purchase, and also which one you feel like exiting to reallocate some of your portfolio monies to.
Yeah, thanks, Jun Xiang. Maybe we move on to the next question that has garnered the top votes. Okay, I have it here. With ETF around, sorry, not this one. What should be a minimum ETF portfolio that investor must have in SGD, and what percentage of capital allocation? So probably this audience asking how much allocation should be in Singapore related ETFs, and how much probably non-Singapore. maybe we can start off with Eugene. What's your thoughts on this? How do you diversify between Singapore and non-Singapore?
Okay, so maybe the framework, I'll frame it in just two simple investor types. One, if you are looking for growth, maybe, and then one for income. All right, this is just very simple. My panelists, you can also jump in. Let's just say classify, you look at the US markets more for growth. Just simply, right? US markets, the S&P 500, or maybe even the QQQ. So NASDAQ, right? You're looking for growth. And then the poster boy for income could be a REITs portfolio, Singapore REITs, or the STI, right? Whether it's matcha or plain vanilla, that's up to you. But generally, right, I would say let's generally classify STI as income. And so then I think the reason why this question is difficult for any of us to give you an answer is because we do not know your specific investment needs and what is your specific investment horizon. Once you understand that, then you can decide whether a growth portfolio is more appropriate or maybe an income type portfolio. So generally speaking, rule of thumb is if you're younger and you've got a longer runway in front of you, you've got maybe you're planning at retirement in 35, 45 years time, you still have a long way to go in front of you. Maybe you can take on more risks. You can stomach more volatility. So you could look at just generally US stocks or growth type of investments, whether it's unit trusts, whether it's ETFs, etc. Then if your runway is shorter, for example, or if you cannot stomach risk, right? For example, you're close to retirement, and if let's say you need the money, and tomorrow the next global financial crisis comes, and you cannot take a hit of 30% on your portfolio, it's very painful for you. Then maybe something that exhibits less volatility, right? That can give you that clip. Every semi-annual distributions, roughly is about 5%, 4 to 5%, and you're okay with that, then that's probably more suited for you. So it's along those two spectrums that you can play around. So that's how you would structure the portfolio. In terms of quantum, you can start as low as $1. You can buy $1, $1 each. So $4, you can get roughly, look at what all of us have. You've got $4, not including trading costs. Philip Securities, I don't know what your trading costs are. Could be free, right? But with $4, you can get a diversified portfolio already, right? So those are the 2 points. And then quantum is just, so then it goes again back to the spectrum again. What's your earning power? Have you put aside, your for basic needs, your insurance, etc., etc. And then out of disposable income, after buying something nice for yourself, whether it's chocolate ice cream for dessert, right? And then another portion to investments. And as you grow older, right, your earning power becomes bigger. Then your war chest starts to grow, and then but the percentages, how you allocate is still roughly the same.
Thanks, Eugene. I'm just quickly move on to, unless someone have more advice to add, I'm going to quickly move on to the one more question, which I thought is rather interesting. At what age should I start investing? Is 50 years too late? 2 years old too late, right? Maybe I'll give this to Rafael, because I know Rafael has been doing a lot of face-to-face client or engagement in his course of work. So what would be the answer to this question?
Okay, so I think, thanks Wei Ching for this question. Prior to the fund management industry, actually I was a privileged banker. So some of these clients, some of them within in the privileged segment, I get access clients which are slightly of an older age group. Whether is it too late or not, I think at the end of the day, you have to ask yourself, what stage of life are you in at that current juncture? Are you still working, or are you looking to retire? And also, perhaps at the age of 50, how many years down the road do you intend to retire? Then that will set your current investment goals. And also, during your years of retirement, how much of it would you want to keep for your next generation, all these have to come into mind because you're not just planning about the investment spectrum. You are thinking about preserving wealth for the next generation as well. So there's some legacy planning involved. So you have to understand within the next, maybe if you are talking about 50, if let's say you want to retire at 65, then your runway is 15. There's a good 15 years for you to still build your war chest before you move on in life. So it really boils down to what do you want to do during that period of time. If you ask me, is it 50 too late to invest? I say, if you still have 15 years down the road before you really retire, then I think, does that make any sense to you that is it too late? And if let's say someone who has already invested earlier on in their life, they want to retire at 50, then I would say that probably you have enough and you can retire already. Yeah.
And I think also one thing to note is about diversification, because we have covered a few asset classes, including by Teck Ling, he mentioned gold ETF earlier on. I think each of these asset classes, if you know, they do have some way a lower correlation across them. And there's also a rule of thumb where if you're closer to your retirement age, your allocation to equities may want to be lower, right? Because equities over the long run, it could be, or rather in the short run, it could be more volatile than bonds. Any other add-ons from maybe Teck Ling? You have something to
Nothing to add to that previous question, but I was just looking at some of these questions.
Sure,
here,
go ahead.
And I thought at least for those that more factual ones, I can try to
Why not?
answer them, right?
Yeah.
So one of them is I'm new to investing. If I want to invest in some of the ETFs covered, do I have to open a POEMS account? Do I need to pay more for a financial advisor? So you can open an account with any broker, even though it's Philip Corporate ETF day today, but you can open an account with anybody to invest because it's traded just like a stock, right? So, you know, it will be, so when you buy the ETF, it will be custodized. Depending on the arrangement, it can be custodized with that broker or it's custodized with the CDP, right? Or SGX, CDP under SGX. So second part is, do I need to pay more? Yes. If you want to have a financial advisor, typically ETF and stocks, it would be a remisier. Usually it would be not so much a financial advisor who would guide you on unit trust more. Yeah, but typically, like if you get advice, typically you also would pay for the advice. Yeah, so there are products such as wrap accounts, right? For example, where basically you pay a fixed fee for the advisor to advise a portfolio of ETFs or securities or unit trusts for you, right? So then they get compensated a percentage of the AUM, assets under their management. For example, that's another model, right? Yeah, so that's one question. The other one I saw was on CPF, right?
CPF OA,
can we buy, can they buy ETFs with CPF OA, right? So as far as I remember, there are just a couple of, say, 4 to 5.
Yeah. For now, there are, I can take this one. There are 6 of them today.
Yeah.
There are 2 STI, 2 bonds. There's a gold ETF and there's a REIT ETF. 4 of them are from Nikko Asset Management, incidentally. So we do, but there is certainly a plan, I suppose, from issuers to expand the list. So probably in due course, there will be a longer list of ETFs on the list.
Yes, probably. The professionally managed funds or unit trust that you can buy with CPF OA is probably a few hundreds or a few thousands.
So I think, yeah. There's one on TR, and in fact, a few of them, right? One of them is, would a lower AUM ETF cost more in terms of TR? What's the average TR for most of the ETFs? So I think for this, we do have probably a couple of ETFs that are smaller scale, but not extremely small. We are seeing 10, 20, 30 million. Whether or not you have a higher TR really depends, but we do have part of them. I think there's always intention at some point for issuer to cap the fees. So there were several of them that with fees cap. When those are capped, then you have a peace of mind that your fees won't go higher even if the AUM is lower. I think we should be almost covered most of the one with good votes, strong votes. Maybe just to end off today's session, any final advice from each of the panelists, and also what the pitfalls? So assuming someone is ready to start into investing ETFs, maybe one or two things that they should always bear in mind. Maybe start off from Rafael and we go down from there. Yep.
Yeah, so I think for ETFs wise, everyone is pretty much familiar with because of its simplicity and index methodology. But as you know, why we compare unit trust and ETF earlier on, I think ultimately it boils down to the index methodology that makes the ETF alive. All right. So if does the index make sense to you? If it does and represents your investment objectives, then I think there's something that you need to accept it. And also, I think while investing in markets, always do bear in mind that there will be risk involved. Yep.
Yeah, I think I think there was a question, is 50 too late to start? We have also had questions, is 25 too early? I think my advice is, if you have not started, it's easy to start. It's also very low cost to start. As I said, with $4, excluding trading costs, you can access to all ETFs generally. And that really starts you on a fairly diversified portfolio. And the good thing about it is that you literally have now skin in the game. And this is where you yourself will be motivated to learn more about all the products that we have, the ins and outs, whether matcha is better for you, plain vanilla, whether it's, Chinese tea, for example. But just using the analogy, right? Once you've got skin in the game, it becomes so much easier for you to learn more, to learn exactly what is good for you. And this goes into something we've not touched about, compounding. If you start early, right? This gives you, as I said, a much longer runway for you to learn and for you to get better. And eventually, if retirement is your end goal, right? Have a good, safe, robust retirement nest plan for you at the end.
Okay, for me, first, I want to thank everyone for listening to Wu Yue Tian today. We have 5 people here. So the Wu Yue Tian of the ETF industry. So, and next also, so if I were to restart my investment journey, I think the key would be actually, it's not about timing the market, but about time within the market. So because of this, that is where like regular savings plans, for example, like POEM's share builders plans come in to be able to allow dollar cost averaging, which is an important approach because you smooth out the volatility and smooth out your entry price by putting a small amount every month in every period to smooth out the entry price. And then the next approach would actually be about doing it in a core satellite approach. So it sounds cheap, but you think of, you go to, for a regular meal, you have a plain rice. But if you want something that is more tasty, maybe you have a mapo tofu to be able to increase the spice and also the variety. So in terms of the core, it would be something like a plain rice. You need a staple. For example, something that is broad-based, well diversified. And the mapo tofu can be something that is adding more potential returns, potential upside, but also potentially greater volatility. You can choose how spicy you want it. So this is the approach to key things: dollar cost averaging through regular savings plans, and then adopting a core and satellite approach. Rice plus mapo tofu, spiciness, you choose it. Thank you.
Yeah, for me, I just sort of echo what Rafa was saying. I think it's important to understand, like if you're buying a certain product, whether it's ETF or unit trust or whatever, just take a bit of effort to understand what that what the product is trying to do, right? Like for the ETF case, what is the index, how it's built, and what it's trying to build towards, and maybe understand some of the key components of that ETF, the index. Then I think it will help you to be a bit more convicted in holding steadily, for example, through a cycle, right? Because you understand it. So because understanding helps you to have greater conviction. Yeah.
Thanks, Teck Ling. So with that, we have came to the end of today's panel. So maybe give a round of applause to our panelists today.
All right. Thank you for the 5 panelists. After or maybe when they're making their way off, I would like to add on one thing as a host and as an employee of my firm. Right, I must mention ETF trading, just in case it was not particularly mentioned. there is no minimum commission on the Poems platform. So feel free to open the account with us. Even regardless of account type, there's no minimum commission for ETF in Singapore. All right. Also, the lot size is only one share, like what mentioned by Eugene. So fairly easy to invest. Can be below $1, slightly more than $1. I think the most expensive ETF you should see might be the Gold ETF, right? So that's the two part. All right. So thanks to the panelists for sharing their views and everything. So next part, all right. We will have the end for the online sessions. All right. Then there will actually be I think the recording on YouTube. If you want to revisit the sessions, even for the physical attendees, if you forgot certain segments, you want to revisit the session, feel free to go to YouTube to see the session again. All right. You can also put in your comments or share with us, but I don't think we answered all the questions. You can also ask questions to your trading rep or your party involved that you are aware of in our company. All right. So thank you for the online attendees. All right. Next.